Hi, it's Jeffrey Cohen, Chicago Quantum, U.S. Advanced Computing Infrastructures Incorporated. How are you? I'm Jeffrey Cohen. I'm an investment advisor representative. I'm also the president and CEO of the company. I'm here to talk to you about stocks and the stock market and what's happening today, and also give you a lens through the Chicago Quantum Net Score, the smart volatility model that we have. And so what you'll get out of this video is you'll see what we see. Today's market's kind of strange, and we'll share some inside baseball from some runs that we did, and so show you some of the answers there. So started off again, Chicago Quantum is our brand, chicagoquantum.com. We're a consulting firm and a registered investment advisor. We are involved in the quantum ecosystem, but we take a very, very different point of view when it comes to stocks. So we have a whole series of quantitative analyses that you can purchase. That's how we make money. We have a lot of market information that we provide for free with a lag, but you get all of this if you buy a run, if you buy our services. We are developing and we are almost ready to go with our alternative investment opportunity. If you actually want to see what it is, you have to contact us either through the website or something. And we have to validate that you're able to see the information. We're not allowed to let you self-certify, self-validate. I got some information on quantum computing, and we got the blog. And so that's what we put out there. We have a lot of free information out there. In fact, let's say you like negative beta stocks. Just as an example, it's from like 2 weeks ago. And you'll see there was a negative net income stock that had a negative beta. There were no positive net income stocks with negative beta. And there were some ETFs and synthetics that had negative beta. So if you really want negative beta exposure, you can buy, as an example, the short QQQ or the TZA. It's good to know, right? And so since then, we've added things to our model, short-term interest rates, long-term interest rates. And so we're able to see the impact of interest rate changes on the stock market, just like any other stock. So it's pretty cool. So that's us. So what do we see today? A couple places where we could look. We like FinViz, we like KoiFin, we like Yahoo Finance. So today's market appears to be up a little bit for the industrials, but down a little bit for everything else. The VIX is up. And you can see energy is doing great, up 1.1%, but real estate's doing badly. So my guess is interest rates are up. You see consumer discretionary, tech, financials. So my guess is interest rates up and recession fears are up. There's a Fed guy who said something about how don't get carried away. The fact that inflation was 7.7 is not game over. It's supposed to be 2. And he said, don't take this as a pivot. It's not going to go your way if you think that we're all of a sudden done. In fact, we did a little math, and if you were to multiply out 7.7% inflation, a $200 dinner 10 years from now is $420. The government will take about 30% of the gains from inflation, possibly 40% depending on what state you live in. So to be able to buy that meal, which is 7.7% more expensive for 10 years, you have to earn 10 to 11% per year more. And I don't know about you, but I don't know that I've had a job earning a paycheck where I got an 11% raise every year just because the Wall Street Journal had an inflation number. Usually you get like 3, 4, 5%. You don't get a lot. And so that's important to know, right? We're not over. So that's why interest rates up, stocks down. It's easy. But you'll notice something else. You'll notice that the NASDAQ is significantly underperforming the S&P 500. In fact, if we hide the others and we go off 5 days, the S&P 500's in blue, NASDAQ's in purple. blue, purple. Looks like it started outperforming towards the end of October. Although here, if you look at it, it's been outperforming S&P 500 since August 12th. And so something did happen. We saw it in our model, and I want to talk about it. I'm going to go back to our website. I don't have to flash any confidential data. I think I can just show you something pretty interesting. If you go to daily price variance, R&D, you see this one's through November 10, because this one we actually really care about. It's really important for you and for us. It's actually interesting information. So this is the variance of the stock prices, adjusted for splits and dividends and things like that. And if you look at companies that made a profit, their variance was 1.4. You don't have to worry about 10 to the negative 4 because all these numbers are 10 to the negative 4. It means it's just a small variance. So 10 to the negative 4, 1.4. And now it's 2.6. So 1.4 to 2.6 is about 80% more variance on the stocks. It's 2.6. If I were to look at the S&P 500, started at 1.2 versus 1.4 for profitable stocks. And it's 2.3 versus 2.6 for profitable stocks. So the S&P 500 is still less risky because it's valuation weighted, it's market cap weighted, and our index is actually just straight equal weighted. 10 stocks, 10% each. S&P 500, if there's 10 stocks, you add up all the market capitalization, how much the equity's worth. You add it all up and you divide, and so the number one stock might have 40% of the money, and the second might have 20, and the third might have 10, and by the time you got to the bottom, it might be 0.01%. And so your small caps tend to be underrepresented, and that helps to stabilize the S&P 500. But what's interesting is that's the S&P 500, or the SPDR. It's an ETF that tracks it. Take a look at the NASDAQ, or the QQQ, which is the ETF that tracks the NASDAQ Composite 100. That's 4.0. That is almost 90% more variance for the NASDAQ. And so you kind of have to go back to the 1950s, the 1970s, and look at basic economic theory that says if you have more risk, you need more return. If you have more risk, you expect more return. No pain, no gain. No risk, no reward. And I never understood this when I was in college. It didn't make any sense. It didn't make any sense in grad school. It didn't make any sense in the PhD program, but it started to as we studied econometrics. Now it makes all the sense in the world. So if you see that the NASDAQ is more risky, you're going to run away from NASDAQ stocks, and you're going to run towards the S&P 500. You're going to sell NASDAQ. You're going to buy S&P 500. And so what people do is they lower the price of NASDAQ until the valuation is healthier, until the expected return is higher. If the stock index was 100 and you trade it down to 50, I'll buy it for 50. It was worth 100 not long ago. Now it's 50, maybe 45. It looks even better. Take it down to 40, take it down to 30, and I love it. I love it at 30. I love it at 30. I have a very high expected return. That's why QQQ is falling more than NASDAQ, or more than S&P 500, because there's been so much more risk in the stocks. And I can show you some examples which you're going to be like, duh, of course there's more risk. And so we started tracking it. And in fact, we started running our entire model twice. In part because we're getting better with the code, and so it runs a lot faster. We run it against the S&P 500, and we run it against the QQQ, because the QQQ kind of, if you're a tech investor, it kind of blows out some of the correlations and covariances. And so the question is, if your go-to is QQQ, what stocks would you buy? If your go-to is S&P 500, what stocks do you buy? They're different. The QQQ requires you to have more stocks in your portfolio and diversify out some of that risk for the same expected return benefit. So something to think about. So this is why I am not surprised to see consistently for months the NASDAQ is underperforming the S&P 500. It's not because it's better or worse, some valuation. It's that there's more risk. And risk requires more return, which requires a lower price. And it's still not done. It's still not done because the risk is still higher for NASDAQ than S&P 500. And in fact, in the couple days we've been measuring it, you'll see that the spread has increased. It was 3.8 on November 9 versus 2.2. That's a 1.6 spread. Now it's a 1.7 spread just a day later, which means there must be a lot more variance right now to take the whole annual average up a tick. So, more risk, more return expected, lower price. That's okay. So let's see. Can we see this? Can we see it? So if I look at the S&P 500, you see even today, the red stocks, the big movers or the bright green stocks, probably the ones in the NASDAQ. Tesla, Bath and Body Works, Amazon, Home Depot, Match, Google, Live Nation Entertainment, Dish Network, Intuit, Autodesk, ServiceNow, yeah, those are NASDAQ, Zebra, Microsoft, Apple, Charles Schwab, BlackRock, Moody's, maybe not, maybe these are not in NASDAQ, right? And then all your real estate, of course, and some utilities. So, Dexcom, maybe. So it'll be interesting to see, right? So the NASDAQ stocks that I normally think of are the big tech companies, not doing so well. They're moving. Even IBM's up 1%. So all the dogs are down. IBM goes up, right? I don't know. It's interesting. Intel's up 0.84. AMD is up 1.7. So big moves. They don't have to be negative moves. They can be positive moves. Big moves. So that's what we see in the market. That's where we're at. And so where do you go from here, right? You can look at stocks. I mean, one thing to do is you can kind of look at where the indices are. S&P 500 is pretty flat. NASDAQ's down 0.2%. The Russell's down 0.75%. Small cap tend to be more risky anyway. What's interesting is the 10-year bond is up. And the 10-year bond isn't up a little. It's up 8 basis points. That's a lot from yesterday. 8 basis points. The 5-year, up 9 basis points. The 13-week is up 1 basis point, which is weird. The TLT, which is 20-plus year bonds, down 0.5%. My guess is if I were to look at other Treasury bond rates, you would see. So I'm doing this all live so you can follow along, right? Treasury yield 30 years is up 1 basis point, but the 10 is up 8 basis points, and the 5 is up almost 10 basis points, and the 13-week is up 1. So right in the middle of the yield curve, 5 and 10 years, you got interest rates going up. So people are like, yeah, I'll believe the Fed. I'll bid up interest rates, which means I got to take stocks down. Because the other thing that drives stocks crazy is when interest rates go up, because companies borrow money. Companies have to have a certain return. Companies get taxed on inflation gains. Taxes go up during inflation. Taxes theoretically go up during high interest rates because they might earn more money on their assets just because assets are more scarce. Imagine a REIT. A REIT owns real estate. Real estate goes up with inflation. So now real estate goes up. if it's owned, right? You're not refinancing at a higher rate, so just assume the same rate. And so now houses are worth more. I'm paying interest. I'm actually paying. I've carried interest or benefit that I haven't paid out yet, and it's eventually when I pay it out, it'll be taxed. Now, what's fun is when interest rates go up, housing prices go down because the next time you sell it, someone's going to buy it at a higher interest rate. So over time, this is going to hurt REITs as well. So I'm always surprised when I see REITs going up. I think today REITs were down. Real estate, yep. American Tower, that's the cell company. Crown Castle, I think that's also cell phone towers. Equinix is data centers. So they're all down because interest rates go up. It really does hurt REITs. And they pay more taxes. So it's hurting them twice. So, okay, that's interesting. So bonds are worth less, at least in the middle. So we're going to look at futures because there's a nice thing here for bonds. So down a third of a point, down a quarter point, down 0.2 of a point, down 1/10 or 10% of a point. Bonds are down. So what else might we look at? We could actually look at what the model said for this morning. I'm going to do this off screen first because it's a little bit of confidential information there. And then I'm going to bring it right back on screen. I mean, if I had music or something, I would play the music for you. That'd be really fun, But we don't have music. We're not going to do that. Sounds like fun, though. Get music. I could dance for you. I could sing. I could give you a quick update on where we're at. So we have slowed down. We need to finish up our new brochure. Our brochure lists our new services, our alternative investment opportunity, which is using the Chicago Quantum Net Score, both long and short, or using a short weighted S&P 500 short. And kind of what you want to do with that, right? That's, here we go. So if I look at the up from the S&P 500, from the 11th. This is all from the 11th. I look at up from the QQQ. And I look at down. So this is the kind of stuff we have to look at every morning. We have to say, where are we with the model? Where are we with the picks? What did we learn anything? Did variances change? Did expected returns change? Did the stocks that were picked by the models change? Were there any stocks that got thrown out because of data errors? I mean, like what's going on, right? What's interesting out there? So that's this. So the other thing we'll get to some of that data in a minute. I like to look at Twitter. I like to look at the tweet deck. So we posted some tweets about Corbis. We thought that was important. We also posted some tweets about CFR, Cullen Frost. And when you look, not a lot of info on either of those stocks. Now you do have a pump and dumper saying, take a look at the watch list, which is always interesting because I don't like pumper and dumpers, so I mute them. You can see 51% short volume for Corbis. That seems pretty high, actually. Why would half the people be shorting? They don't own it, right? Sell it, run away. If you don't like it, walk away. You don't need to sell more shares than you own. And Cullen Frost, just nothing, right? So nothing going on. That's how I see it. So I can get rid of that. Get rid of that. I look and see if anything has changed today. The Dow was up. That's interesting. It looks like communications are up, healthcare's up. So probably some of the bigger Dow stocks are doing okay. S&P's flat, Nasdaq's down 0.2%. And so you still see the same thing where until the Nasdaq kind of chills out and stops being so risky and volatile, much more risky and volatile than the S&P 500, you're going to see this underperformance. And I don't think this is going to change anytime soon. I really don't. Here's Cullen Frost. We look at that on a regular basis. Here's Corbis. So Cullen Frost is up a few pennies, 39 cents. Corbis is up less than a penny, quarter of a penny, which is not a lot. Nice to see it's up, though. That stock always falls. I'm surprised that stock isn't zero by now. It's awful. It's an awful stock. We love it, though. We own a lot of it. Amazon will lay off 10,000 employees. That cannot be good news. There's nothing else here. Binance, which is a Bitcoin crypto thing, it's flat. Just nothing going on. There's no news. There's no news. So that's why nothing's happening, right? And the only thing I see is the market's pretty flat. It's moving, but it's flat. NASDAQ not flat. Dow slightly ahead of flat. Why is the Dow doing better? I wonder what's going on. Don't know. Don't really care, if you really want to be honest. I just see interest rates are continuing to be higher. That's really not that helpful for stocks. I bet you the dollar is also... bet you the dollar is weaker. Well, that's interesting. It's at $1.344. Only a tiny change. We're at 140 yen per dollar. That number was like 150 not long ago. Great British Pound is still pretty weak at 117. This is interesting. The dollar to the renminbi. You're at 7.07. This was always like in the sixes. So the Canadian dollar is weaker. Not Canadian dollar. What am I, an idiot? The Chinese yuan, renminbi, is weaker, which allows the Chinese to continue to export goods and services to the United States. Mostly it's products. The ruble, the Indian currency, those are tough, right? The Mexican peso, though, is strengthening a little bit against the dollar. So where's Canadian? I don't see Canadian dollar. It's really weird, but that's fine. So dollar's not really moving. Nothing there. No story to tell. So we're going to get out of some of this stuff. We'll just keep this part of this page up while I look at while we look at the runs and we see what they tell us. Now, we have stopped our runs on Friday because we are doing an accounting of our runs to see, did they really make money? How did they make money? What were the lessons learned? And how much money did they make? We traded them for 2.5 months. And the question is, how good was it? And so we're going to come back and give you a real answer. I was supposed to work on it this weekend, but my wife kind of monopolized my time. Everyone was off. So it's like, all right, we just got to focus on what's important, which at this point is family. So the S&P 500 variance is 0.23. NASDAQ variance 0.40. The up stocks 2.6. The down stocks 7.8. That's triple. So if you looked at the stocks of the profitable companies, 2.6. If you look at the stocks of the not profitable companies, they could have lost 1 penny. It doesn't matter. They just didn't make a profit. The variance on those is triple. Triple the variance when you turn into a money loser. Wow. There's a bunch of dogs now. Roof. Now, the first thing to notice when you look at this is these are all biotech. The top 6 are biotech. Then we have Desktop Metal, which actually we don't short that one because it actually looks like a normal company. Normal. It's not, but it looks normal. It's losing money because of a write-off, a non-cash charge. All the rest of these are still biotech. And then Everbridge, that's one we shorted for like a month. And then Snap we shorted for a long time. And then Grab. Snap and Grab. AMC, VTNR, Vertex Energy we shorted a little bit. And then you're back to some biotech. And so it's mostly biotech in the top 30. In fact, you keep going and there's more biotech. So, of course, lesson learned. Biotech, very risky. Biotech, the risk doesn't justify the return. Got it. You know, a wise man once taught me that. Desktop Metals. Bore Drilling. Everbridge. Snap. Grab. AMC. Vertex Energy. These are companies that have a market cap greater than $400 million. They've traded over $1 for the whole period, for the whole year. They passed all the other data validation, and they lost money. And so that's it. So you'd say, Jeff, so what do I do? Well, you don't short a lot of them. Because what happens is if you short a lot of them, you diversify out the benefit of them being down-run stocks. If you bought a lot of them, if you bought all the stocks on this list, your variance would be triple the variance of if you bought all the winning stocks. But if you just bought these, like one of them, or 2 of them, or 3 of them, your risk is hundreds of times more than if you just bought the S&P 500. So risky, right? And that's the game. That's the short or down run game. Well, let's look at the up run. So this is QQQ. Just to make it easier for you to see, I'll just do QQQ up here. And this is S&P 500 right here. Now, not to show any dirty laundry, but these stocks, which are mostly banks, do not issue 10Qs. And so they, generally speaking, don't have a market cap. They don't have the stuff. Now, they're not all of them like that. Like Qubits is D-Wave, and that's just a new stock. It hasn't traded for a year, and it's Canadian, and it's whatever. So they don't have a 10Q. They're Canadian. So whatever. It's interesting because we exclude all stocks that are listed as being non-U.S. companies. Like here's 2 more we've got to remove, which is Perimeter Solutions out of Luxembourg and Theravance Biopharma out of Caymans. We will remove those the next time we run our model. So they'll forever be gone. So what did we learn? We learned that there are 11,035 tickers that traded in the United States on Friday. 11,000. 1,531 of them passed their data validation for being profitable and positive beta and all the good things, right? The expected return if you held all 1,531 stocks is 9%, 9.1. That includes dividends. And your all-stock variance, that variance of that portfolio would be 2.6 times 10 to the negative 4. Here's where it gets interesting. For all you savvy stock pickers out there, the best 4 things you could hold if you could only hold one stock. So you know how on Twitter, I'm sure I could find one, right? You know, Twitter, what is the one stock? If I gave you $1 million, what's the one stock you would buy? Something like that. Name one stock you're holding forever. If you had a chance to buy only one stock, what would it be? It would be the S&P 500. Next, it'd be the QQQ. Next, it would be a short-term bond fund. Next, it would be the Russell 2000. There's a reason why these indexes exist and these ETFs exist. They are efficient. You'd buy the Goldman Sachs Physical Gold ETF if you like that kind of thing. We used to hold 3% of our wealth in gold. That was our thing. And so let me see if there's anything else out there that is an interesting ETF. Nope. So it's so funny. This is the thing that they don't want you to know. Like the secret. Don't tell people how to invest their money smart so that you can have them pay you a lot of money and give them advice. Well, here's the problem. The problem is I don't want retail investors' money. I don't. I'm sorry. If you're a retail investor, I'll just teach you stuff for free. I don't want your money. I work with institutional investors. I work with high net worth individuals. I work with companies. I don't work with individuals, right? And so if you're an individual and someone gives you money to buy a stock, somebody dies and you inherited money and you can only buy one stock, that's stipulated in the will, you buy the S&P 500 or you buy the QQQ or you buy a 1 to 3 year treasury bond ETF or you buy the Russell 2000 ETF. IWM. So it's SPY, QQQ, SHY, or IWM. And if you're kind of radical, my son actually likes gold. You buy AAAU. Goldman Sachs has a physical gold ETF. That's it. Wrap it up. It's not complicated. You don't have to manage these. You buy them, you put them away, you retire. That's it. So that's what the model says. It's so interesting that that's what the model says. Now, I bet you we're going to find something else interesting which makes me uncomfortable, actually. Because it justifies what Father Time and the bearded people who like to sell you stock advice on the TV say. So, oh wait, I have a goatee. Shoot. And I'm a little bit older. And I'm on YouTube. Shoot, this is bad. All right. So what's the answer here? So I'm looking at the QQQ run. The best answer is 8.6, negative 8.6 times 10 to the negative 5. If you only wanted 4.9, negative 4.9 times 10 to the negative 5, you could just buy 3 stocks. Now you're giving up half the alpha. You're giving up half of that benefit. But let's be honest, you're going to pay us a fair amount of money to manage your money actively every single day and to balance portfolios and to call you and to do statements and custodianship and all that stuff. If you wanted half the value of our model, now why am I telling you this? I don't know. I am the worst business person I know. That's kind of what I'm telling you here. I'm a bad business person. But you could buy QQQ, SHY, and SPY, a third, and get half the benefit. Maybe a little bit more than half. So let's remember what those are. Those are the top 3 stocks in our model, held evenly. They're all negative CQNS scores. They're all better than break even, but put together, wow. So it's a 66.6% stock, 33, probably 0.4% bonds. Or it's 2/3 risk assets, 1/3 no risk asset. The problem is you can't really call SHY no risk. My guess is if I had a day-to-day interest rate, it would have picked that. But right now I only have SHY and I have TLT in there. So QQQ, SPY, and SHY, which is a 1 to 3 year bond fund, treasury bond fund, no risk bond fund ETF. That's half your benefit right there. It took 234 seconds to come up with that answer. That's 4 minutes. So Jeff, you download the data, you do all this validation, you do all this great work, and then 4 minutes later you can tell me to just buy the 3 top picks in your model. Yeah, that's it. Buy the 3 top picks in the model. Now, what's interesting is the spider. When the spider is your comparator, it doesn't want you to buy that. That's only with the QQQ. See, the spider run is different. This one, your best answer is 2.0 times 10 to the negative 4. So it's a bigger edge. So 2.0 times 10 to the negative 4, and the equivalent solution is 5 stocks. It's QQQ, it's SPY, and it's 3 other risky stocks. It's BX, MS, and SWKS. I don't know who SWKS is, but BX, I believe, is BlackRock, and MS is Morgan Stanley. So it's saying buy 40% indexes, 40% money managers, and then whoever SWKS is. We're going to find out because I'm curious now. I'm not logged into Yahoo Finance, so there's no special coding or anything. Skyworks Solutions. Never heard of them. What do they do? Semiconductors. Okay. Out of California. All right, they make semiconductor products. They make the bits and pieces. That's fine. So that's what you're supposed to hold. That's so interesting. So I'm okay with that. Now, what other interesting? I mean, I've got things like positive, negative skew, leptokurtic, platykurtic, stocks that have risen the most, stocks that have fallen the most, high dividend. Oh, high dividend, because who cares about low dividend? High beta, low beta, negative beta. High volume, low volume, spike volume. All kinds of stuff. Yet on Friday did they have high volume, compared to what they normally have. Here's the answer. Now this answer is not going to mean much to you, but I'm going to show it to you anyway because it's $750 to get this answer. Now, S&P 500 and QQQ, I haven't figured out that I could probably charge for those separately. Again, not being the best businessman, I'd probably just give you both for the same $750. That's okay, it doesn't matter. I'm going to figure out how to bring them together anyway. So that's your best portfolio there. That's your best portfolio there. You see the score's different. The S&P 500 based one has a much higher alpha than if I ran it against the QQQ, because the QQQ, again, has blown out a lot of the benefits because of the increased variance. It's just hard to get a lot of correlation. So this one is 15 stocks. This one is 10 stocks. They both have AMD. They both have APPS. They both have BX. They both have SYNA. But they don't both have Surgery Partners. They both don't have SI Time. They both don't have Coinbase. Nor do they both have Amazon, Apple, MXL. That's not Mercado Libre. That's a difference. Max Linear. Meta, Rocket Mortgages Company, Tesla, Fortinet, Intuit, Earwax, which is European wax. So it's interesting, right? So you could buy one, which they both have very similar base portfolios. At least half the stocks are the same. But then you see this one, and TGI. This one's got different risk adders than this one. On the down run, I already showed you. You're buying some combination of Desktop Metal, DM, Board Drilling, BORR, Everbridge, Snap, Grab, AMC, VTNR, which is Vertex Energy. We don't play around with law, CS Disco. Anything with disco in the name, I'll be dancing through hoops. I can't do it. I can't do disco. I'm sorry. It actually seems really weird. Disco. Like Disco Inferno. I'm staying out of that. All right. So where are we at now, Jeffrey? What's the story? Well, the story is we got a lot of work to do. We're working on our brochure. We're working on our accounting and reporting on how our portfolio did. We're watching the stocks. What's interesting is they're not really moving. I mean, there's people that trade for the 15 points. That's not us. I can't make money going from 39.92 to 39.74. I just don't know how. It's 0.5%. That's not our game. I can tell you, though, that we can make money, at least the model's goal. We cannot promise any results. The model's goal is to make money every day, most days. Small drawdowns, make money most days. Some days you have really great days. Some days you do lose. And then you make money consistently every month because you're effectively betting volatility, smart volatility against dumb volatility. Or you're buying smart volatility versus a beta-weighted market, which is fine. All right, so hopefully that was helpful. It might have been. What else would we look at? What else is going on? So there are a few other things we'd look at. Maybe I can show you something. So we'll come back here for a minute. And you see the S&P 500 has gone into positive territory, 0.1%, but the NASDAQ is still 0.2% to the negative. So just 0.3% spread between the two, and then you see the NASDAQ's even worse. It's a 0.5% spread between the two. The VIX is up to 23. The industrial is doing great. I think actually our portfolio is about break even today, our personal portfolio. That would be a combination of Corbis, which we love. God, we love Corbis. I might have to buy some more just because I love it so much. My wife says it's a little bit of maybe a sickness. Keep buying Corbis. Jeff, you've been buying this since $1.25. What are you doing? I'm like, it's good. It's good stuff. It's worth $1.25 to me, not to you, because it could go to zero. This is like the highest risk stock in the history of stocks that I've ever followed. But I like it. I actually think there's intrinsic value here. And at $13.74, it's still a super deal. Then you have Cullen Frost, which I think is the worst bank, except for maybe FFIN, but FFIN has some better growth prospects. They're seeing trades like between 3 and 4 times assets. Come on now, it's a bank, a regional bank in Texas. It's not like they're Tesla firing SpaceX rockets to the moon. It's a bank. It's a bank that's losing money every quarter, loses a lot of their capital. They're draining their capital. They're a bank that was formed in the 1800s, and they have somehow managed to lose a third of their capital this year. The Texas Rangers, who are probably part of the bank when it started, are probably turning over in their grave right now because the people at Cullen Frost have lost so much of their hard-earned money. At some point, it won't even be enough money for depositors to get their money back. They're not that far off from that. They're maybe another $2 billion maybe away from that, away from rolling it up and being insolvent. Now, a lot can happen. Maybe they make more profit. Maybe interest rates change. Maybe they bought swaps. Maybe Bob's your uncle. But right now, Cullen Frost, in my book, is the second most expensive bank in the United States, based on a market cap to tangible book value, or even intangible plus tangible book value, total book value. It's the second most expensive stock. So, good luck out there. Yeah. It's no Corbis. And how are we doing with them? It's just floating around zero. It doesn't matter. Bitcoin's up less than 1%. There's nothing going on. This market is boring. I should go back to work. What are we doing here? So Iran protests continue. There are a few things that have happened. What's interesting is none of these seem to matter. None of it seems to matter. All right. Market's kind of boring right now. But that's okay. Boring isn't necessarily bad. We'll take boring for now. I want to thank you for watching. It's been really great. And we'll just take one last look at the S&P 500 while we wait. And we'll look at a one-day chart. We'll look at it with candles. We will try to cram some more stock move in there. There it is. And we're going to draw a line. A couple of lines. Jeffrey, why are you drawing lines on a chart? Well, the first one's a regression line or trend line. And we'll draw it from today. And we'll see that the market has been roughly flat from here. And it really has been on a downward trajectory. Look at how steep. Look at how steep that is. Downward trajectory. So what I would say is the market's probably going to come back to like 3,700. 37, 36, 35, 38. Right now it's looking great. It's going up. It's a hot market. So now we're going to draw a different kind of line. Now we're just going to draw a straight line from the top closing price to the top closing price. And you see how it touches all three tops. And it says there's a lot more room here. This stock market can go to 4,100. It can. So you got a trading range now. You got 3,750 to 4,100. It's 10% trading range. Probably not that off either, you know. Looks like it wants to test that 4,100. But even if it did, you're just bouncing back to the support line. And you're probably going to end up at the lower end. So just be careful out there if you're buying a lot of stocks. I just don't see... I don't see it. I do see, though, that the S&P 500 is better than QQQ. So let's try to do this chart with QQQ. Actually, with the index, the NASDAQ index. So let's try it. Can I clear the drawings? Yes. So this is what I do all day. When I'm not specifically trading the model, I'm farting around with drawing lines. I don't know that that's a good thing to be doing, but it's what I do. Oh boy. There it is. So straight line is only there. It's not been a very long straight line. And that is the most... It's probably not bad. Let's do a little more. And then we're going to draw the line on the top. That seems to have a lot of explanatory value. From the, not from there, from here. From the close. To the close. Now if you look from the close to the close, you've got a lot of room. The first chart, the first line doesn't help you. This line helps you. This line, I'm going to get rid of that line. That line doesn't help you. So you can see how, go ahead over there, that's fine. You can see how you're following that same trend line down, which is like the S&P 500. It says we're in a bear market, it's fine, the tops, lower highs, higher lows, whatever, lower highs, Lots of room. You can go to 12,000 from 11,200. You can go 800 points. It's like 7%, 8%. It's fine. And down here it says 10.8. So it's 10.8 to 1,200. It's actually a 10% spread. But this would say you're probably going to drop even more. You're probably going to hit like 10,400. So 12 to 10.8. Okay. 10% spread. Things been looking up. It's nice, right? Could still go up another 10%. 10%, or nah, it's more like, what is that? 750 points? It's like 7%, 6%. Still go up another 6%, but then it's expecting to go lower. The trend on this is lower. That's all. Not much to say about it. So, am I putting my money into the S&P 500 and NASDAQ and SHI? No. I'm waiting. I'm in mostly SHI type stuff. I'm in bonds with low duration, with near-term maturities. We're not making much money. We're losing on inflation, but you know what? At least I got my capital. I play around with stocks. I play around with Corbis and Cullen Frost and Verizon and Qubits, but that's not real money. That's kind of a small money. So I don't know. I think you just have to decide, are you in the game to make 7%? Now, if you're buying options and the stock market goes up 7%, I mean, you're making a boatload, right? But it could drop 7%. So you could lose a boatload. I don't know. So it's too hard. It's too hard for me to make money that way. NASDAQ's down 0.5%. S&P's down 0.2. Again, relative overperformance of the S&P 500. Due to the difference in variances between the two exchanges. All right, we'll wrap this up. Check again. Check in on Cullen Frost at 146. Basically flat, up 0.2%. Corbis bouncing 13.5 to 14, up 2.5%. Still not bad. 1%. Still not bad. I may have to go in there and buy a couple hundred shares just to show some solidarity. Love it. Love that stock. And you can see we're starting to drop again. Again, no idea. Oh, one other stock, right? This is why biotech is so volatile. Satsuma. I used to be a huge fan of Satsuma. I used to have a huge position in it too. And they're making a nose spray, like Fluticase, that helps with migraines, but it doesn't work. Today, Monday, the 14th, they came out and said it didn't work. It didn't pass. Phase 3 didn't pass. So the stock's down 83.5%. The stock's down 83.5% because it's a biotech, and if their one biotech candidate doesn't work, you're out. You're done. Wrap it up. Go home. That's huge. And the fact that I know that company, I think I've actually emailed or texted with the CEO. I mean, there's like a whole thing there. I love that company, but it didn't work. It didn't happen. So that's rough. Anything I know about going up the other way? Not much. I have not really seen any of these stocks. So, all right, well, that's where we're at. Let's check the news one more time. I spent all day doing this. It's such a waste of time. Amazon to fire 10,000 employees. I mean, my mornings are busy because that's when I decide what trades to make and how I'm going to play the day. And then during the day, I'm just watching a lot. Nothing happened. Nothing happening. That's what's amazing with this market. No one knows who's going to control the House. The Senate is staying Democrat. More shooting. You know, I feel less safe every day. Ukraine fighting the Russians. Did pretty well. A lot of violent crimes. I think something's wrong when there's so many violent crimes. I do. I just don't think it's right. And we're not getting like news about like productivity. we're not getting news about things that are important to business. We're hearing that Tesla heads to court. Jeff Bezos is going to give away his money. A cryptocurrency is failing. There were so many stories about FTX over the weekend on Twitter, right? Black Panther made a lot of money on the movie. You know, we watched the other movie, The Bullet Train, and I can see why it maybe wasn't a box office smash. It was okay. There's no news. So there's no news. So there's nothing going on. So that's why you have stocks not really moving. Kind of flat. Down 0. Down 0.1%. Right? Down 0.5%. Very flat day to day. A little ups and downs because people are trying to invest. They're trying to trade, make money. But it's so interesting. Don't know. So I want to thank you for watching. Appreciate it. If you like the video, we're not paid to make the videos. Please do me a favor. Hit the subscribe button. It helps. Drop a comment. Let us know if you liked it or not. Maybe ask a question. I'd be glad to answer. Anything we can do to engage with you would be terrific. If you actually want to learn about our alternative investments, again, I've got to be super careful because I'm not allowed to talk about my alternative investments with people that are not able to hear it. So, alternative investment opportunity, you go there, it's password protected. But if you call me up, you send me an email, I promise I will, I'll ask you the questions I have to ask you, I'll give you the password, you can have all the information. That's what I want to do. I'm sorry, it's not my fault. I'm not doing it on purpose. We are investment advisors. We are FINRA brokers. You can check us. It's great. I got a phone number. I got an email. We're not hard to find. Contact. We're not going anywhere. We've been in business since 2010. And you could just buy a run. This you're allowed to do. $750 will give you a full analysis of all of it. Of everything. Give you the whole thing, including a spreadsheet of every stock that was in the thing that passed validation. There's a lot in here, so just take a look. It's good. If you tell me that the money's too much and you don't think it's worth that much for you and your special circumstances, or maybe you want to buy more than one run and the price is too much, you can talk to me. We'll figure it out. I want to help. I want to get engaged, right? Not looking to squeeze every last nickel. So I will say this roughly approximates the value per run. And so it is a fair price. And it's more fair if you have a lot of money to invest. If you have $1,000 to invest, you're not going to spend $750 to take the $250 and make money. But if you had $100 million to invest, this is chump change and you can make a lot of money. And so that's how you think about it. All right, hit subscribe. Tell people, maybe share the link. I think there's a button called share. You can share the link with your friends. Say, hey, I really like this guy. He's kind of cool. Talks from the heart. And we'll go from there. Again, just to give you the last flash, the stocks that the Spider model picked were AMD, Apps, BX, Coin, Melly, NVIDIA, Surgery Partners, SITM, SYNA, Synaptics, and TGI. And the ones that the QQQ picked are different. Apple, AMD, Amazon, Apps, which is like App Dynamics, BX, Blackstone, Earwax, which is European Wax Center, Fortinet, FTNT, Intuit, Melly, Meta, which is Facebook, or the Metaverse, MXL, which is Max Linear, NVIDIA, Rocket Companies, think Rocket Mortgage, Synaptics, and Tesla. Those 15 stocks will outperform just holding the QQQ. These 10 stocks will outperform just holding the Spider. And this is a bunch of dog crap, which you don't want to hold. And some people would rather short it. And in fact, we have a version of our of our alternative investment program, which shorts stocks like Desktop Metal, Board Drilling, Everbridge, Snap, Grab, AMC, Vertex Energy, or some combination depending on how the math works. And generally speaking, that makes the most money. When you short the dogs and you buy the good stuff, you do better. But there's a little more movement, a little more drawdown and ups. You have a little more of a balanced, just pure profit play if you do it against the beta weighted. So, all right. Again, thanks very much. Appreciate you watching. Bye-bye now.